Let's talk about the markets. We've seen a good reversal from mid-November lows, right? We are 1,000 points off lows, and there's some bit of good news as well, right? Of course, notwithstanding the Maharashtra poll verdict, which proved to be, the factor that led to this recovery. But FIIs have also turned buyers for the last three sessions at least. Would it be too early to call a trend reversal? Because China is not the only threat now. It's money flowing back into the US. That's the bigger threat. So how would you read into the current leg of rally, and what do you make of the kind of reversal or short-term reversal that we have seen in the FII flows?
Yes. So if you look at Maharashtra's election, was to my mind not a big event, and that's why you see that on 25th we've seen about a 1%, 1.3% up move on Nifty, and the broader market was almost there. And we've for the last 3 days after the Monday, we've been flattish from the levels where we closed on Monday. But the rally on the last Friday, which was about 500, 550 points on Nifty, was a very, very unique rally because of the FI short positions having reached 76, 77%. See, bigger falls. Now, if I backtest this data with respect to regression and also try to do some predictive analytics, FI long short, if crosses 70, you can't have sharp falls. If it crosses 85, you can expect reversals. For small good news, you will see bigger rallies. That's amplified movements you will see on the positive side if the short build-up is 85%. Now, if you look at Monday, 9,200 crores of buying which came from FII. Now, if you tally who sold on the date of election results, retail and others, which is corporates, Indian firms, have sold about 4,000-5,000 crores. First time for this year, for this month, DII sold about 4,000 crores. So this 9,200 crores, which FIIs bought, was sold equivalently by Indian participants. That's why I call Maharashtra election not a very, very big event from an Indian sentiment standpoint. Point three, I think China is definitely was a risk. But if you look at $900 billion, out of which an FII, if it changes, takes away 1% of it, 1.5% of it, it could just be rebalancing. See, when an asset class does well, when we tell clients to rebalance back into debt and equity, why is it not going to be relevant for an FII to rebalance between India and China? If China has underperformed and India has outperformed, you will have to rebalance your weights. And that's 1.5% of the total FII holding. So it doesn't perturb me too much. I think the Trump election result is more of a positive. And I'll give you some data points to substantiate that claim.
Okay. So post the Trump's victory, if there's one Trump trade that I would like that I would urge you to point out, which one would you choose? Would you choose IT or would you choose chemicals?
See, if you ask me, Nanda, I would say that it's very important to look at trades more microscopically. If you're wanting to trade sectors, I don't think these are very good times to trade themes. You will have to go really bottom up at these valuation levels. You can't be top down. That's my right or wrong assessment. Now, if you really want to play the FII card, you have to go microscopic. And the barometer for that is FIIs in this calendar year have added number of shares to 168 out of 250 shares in the small cap index. The NSE small cap 250 index has 250 naturally, as the name suggests. 168 stocks FIIs have added. There are 17 stocks where they've quadrupled the number of shares they held on 1st of January to 31st of October. So if you go microscopically, if you want to feel being participating with the FII, then I would rather go to these 17 stocks where they've quadrupled their holding. And FIIs are very price inelastic. So if they want to add shares, they're not going to be very price sensitive, unlike the domestic institution as far as my interaction as a listed company goes. So I would say not sectors. If you really want to play the FII card, go bottom up. Find out which are the 17 stocks, and probably I can read them out to you. These are some of the stocks which you can play on the screen subsequently, Nandita, but I think you'll have to go bottom up and not theme-wise.
A lot of fund managers I spoke to before the recent leg of up move had said that it's time to keep dry powder. It's time to perhaps take some cash off the table and sit on cash for now. But do you think now is an opportune time to re-enter the market? Would you advise looking at and accumulating quality stocks right now, or would you ask investors to wait for a bit and then jump in? Is the stage set for a Santa rally before a pre-budget move in the market?
See, when you hear fund managers, you have to classify yourself and saying that whether this information is relevant to me as an individual or not. If you're speaking about 4 5 year kind of time frames, I would always buy at a level where I'm almost 8 10% lower than the 52-week high of Nifty. If I get any discount of 7 8 10%, I would definitely buy if it's long term money. What more discounts do you want? Why do you want to go to the shop when the discount sale is last day? You would generally go for good stock on the first day of the discount sale. So 8 10% is always meritorious in an economy like ours to buy that dip if you have 3 4 5 year money, which is whom we deal with. 11,000 clients whom we deal with have intergenerational wealth. So we tell them to buy if you're not at 52-week high. That's point one. Point two, if you're a trader, then there's a lot of barometers. I see short-term 5 barometers which have proved themselves in predictive capability. One thing which people miss out, and I'm very surprised that India has hardly spoken about a circular, which was on 22nd March 2020, a day before the lockdown. There was a circular which limits the number of shots in India. I can't, as an FII, if I don't have long position in India, I can't sell more than 2 lakh futures today. So that's why the volatility of India from that day on till now is lower than S&P 500. S&P 500 is 50% of India's world's market cap, and it has larger volatility. 18.59 is the standard deviation from that day till 31st October for S&P 500, which is a 500 stock, and Nifty, which is a 50 stock, which represents only 2% of the world market cap, has a lower volatility at 18 from that day, because India is not a short conducive market. That's why you don't see sharp drops. Given that kind of a circular, I would be very confident volatilities will remain muted. And I hear so many experts saying volatility is high. What high are we speaking about? You have lesser volatility. 18.59 is S&P 500 and Nifty is 18, and still people without mathematical check say that India is more volatile than S&P 500, which is not the case on an Excel sheet.
Well, that's a very interesting point that you've raised. Although people have said that we've been extremely volatile, you say that it is lesser compared to what we have seen in the US market. You've said that it's time to take a bottom up approach rather than a top down approach. But still, I would urge you to share your thoughts on the PSU lot, because although you've said that FIIs long short is a much larger point that has led to the recovery that we've seen in the market. But PSU stocks are back in the limelight. We've seen stocks like BEL performing well over the last few sessions, and all the other PSU banks also have seen a good run. So if somebody has to take a bottom up approach, should one look at the PSU lot right now? Is after the correction, is the risk reward attractive there?
Yes, definitely it's attractive there. But you, as a direct equity investor, there's so much analytics one should do. Like we only deal with mutual funds, and we have 17 people only doing research of short term and long term so that we can advise our 11,000 clients. So if you're buying direct equity and PSU, you first have to understand your style and the market dynamics. If you're a growth style investor, I will give you some barometers which you can choose some PSUs. Don't buy all of them. If you buy all of them, then you're over diversified. You will never make money. If you look at mathematics, you can take decisive actions and buy 2 of them. How do you buy 2 of them? If the mean valuation, if you're a value investor, make sure that if the mean PE for the last 4 years is X, if it is, and the standard deviation is 4, if it is 3X, 3 sigma more, then I would not buy as a value investor. But as a growth investor, I'll surely buy 2 sigma more than valuation, because I'm going to be only invested for 2-3 months. So you have to first ask yourself whether you value long term or growth short term. If you're growth short term, buy expensive and quit when it reaches 4 sigma valuation limits. That's what I do. And if I've back tested this, you will beat Nifty by about 4-5% handsomely with a lower risk in terms of beta with Nifty.
Right. Last couple of questions, Feroze. In terms of mid cap versus large cap, where do you stand? How much allocation should go towards mid caps now?
This is a question which I might change the answer very swiftly, because we look at some data on a daily basis, which is nothing but the flows in mid cap and small cap yesterday in the funds. So when it comes to mid cap and small cap, it also depends on what were the last 1 week flows. Once the flows start turning downwards, then the differential return which mid caps and small caps have given the last somewhat, which is the number I remember, which is about 20-21% between mid cap and large cap outperformance relative to Nifty. When you look at this barometer, last maybe 20 days, if I'm not wrong, small caps in India, small cap funds have kept giving cash flows positive by net investors. Net cash flow is positive for all small cap funds put together. Not that you're worried only about small cap, but that is the cumulative barometer of the sentiment of a institutional investor. And that's a very important thing. If 10 days, if small cap continuously gives you redemptions, then I would change my stance very quickly, because last 1.5 years we've been bullish on small cap, mid cap, when people gave in, dropped their hats in the ring about a year back. So we've been bullish for the last year and a half, and we continue to be till we see reversal in the sentiment. And then I will definitely book all my profits from small cap, if not all, a substantive portion of it.
All right. Lastly, in terms of asset allocation, as we step into the new year, would you recommend any particular setup? What if somebody is looking to change their asset allocation within the portfolio? What should they keep in mind now as they step into new year?
Yeah, so the same person could have two asset allocations depending on the pot of money he's talking about. If it's first, you bifurcate your money into two pots, one which I surely not touched for the last 5 years, and there is no requirement of that. Then I would say 80-90% in equity. If you have the courage to weather the volatility, and volatility will show you 10-15% drawdowns from the peak every single year. If you can weather that, then you will make at least 13-14% return on your overall portfolio. So I would definitely, even with mutual funds, want to at least double my money every 5 years. On the long-term portion. The short-term portion, I think you should go 50-50 if the weighted average goals period is about 2.5 years.
All right. That's the view then from Feroze. Feroze, I'd like to thank you for taking out time this morning and joining us. Always a pleasure chatting with you, and I look forward to more interactions with you in the future.
Likewise.